Hello, welcome to Any Answers Answered for December 2020. Obviously, people now have one eye on tax return season, but hopefully you've had time to join us for Tim to answer a couple of questions. Tim joins us remotely this month, and our first question comes from the rather wonderfully named Snickers in a Twix, who asked the question as follows. 20 years ago, the client lent his parents £50,000, which was half the price of a house, so they could buy the house. The client's name didn't appear on the title deeds. The agreement was that when the house was sold, the client would receive the money back plus half of the increase in value of the property. The client has received £110,000, and so the question, quite simply, Tim, is this £60,000 that we've received, is it capital gain? Is it income tax? What is it?
Well, we need to drill down into precisely what contractual arrangement was entered into, because that's what will give us the answer to the question. And as is not unusual in this sort of case, there is no formal loan agreement in place as far as we can tell. And although there's reference in the question to an agreement, that could just as easily be a verbal agreement as a written agreement. But if there is a written agreement, it would certainly be very helpful for us to see it. There are quite a number of contributions to this query on AccountingWEB, but if we go down to the most recent, then I think perhaps the most helpful contribution is one that gives us a link to a Taxation magazine article that was written 8 or 9 years ago. And that article does confirm what I would myself suggest, which is that the additional amount that's paid when the loan is repaid will count as interest. Effectively, it's a premium on the loan repayment, and there's case law that the revenue would certainly rely on to support the argument that that should be taxed as interest. So unless we can come up with some other analysis on the basis of evidence, which I don't think there is here, I'm afraid we are going to have to treat that as interest taxable in the year of receipt on the individual who's made the loan. Now, there is in that article in taxation, and you can go to the AccountingWEB and get the link to that. One suggestion, and I disagree with it, but there is one suggestion that this is merely a family arrangement that falls outside the scope of tax, but I wouldn't want to rely on that these days. And I think the moral of this question is that where these arrangements involving significant sums of money are entered into, it is always essential to dot the I's, cross the T's, and have the agreement in writing. And had it been written down, I hereby lend £50,000 to help my parents buy this house, on condition that when they sell the house, they will repay said 50,000 plus an amount equivalent to half the profit on the sale, whatever the arrangement was. That agreement is then a formal agreement in place. Everybody knows where they are. And on the tax analysis, that would then be taxable as interest, not as a gain. After all, the individual making the loan to his parents has no interest in the property. As far as we can tell, there is no direct interest in the property. So it's not an asset in respect of which he is making a disposal.
And of course, one of the things to think about there is that actually capital would be a much lower charge, of course, and had the thought process been run through in the first place, we might actually have been in a position where we'd have preferred it to be listed formally, if you like, as a capital transaction to try and get hold of those 28% potentially tax rates, as opposed to income tax, where we would be looking at a far higher rate. So actually, whilst silence has occurred here, perhaps in a hope that nothing will be taxable, I think that's unlikely. So we have to say that, maybe it would have been better off if this had been thought about in the first place and an agreement that it was capital entered into.
Exactly, yeah. And although the savings rate band might be available, personal savings allowance, it depends on the lender's circumstances when the loan is repaid, but we could be looking at 40% tax on most, if not all, of that interest.
Well, that conversation about capital versus interest capital versus income, leads us nicely into our second question this month, which actually comes from Open House. And what Open House is asking is, one of their clients has bought a rundown property in 2018 with a view to doing it up and selling it on. Never lived in it, never rented out. However, what's actually happened is, yes, they spent some money on it in 1819, a little bit of money in 1920. They've now sold it in June of this year at a loss. And the fundamental question that's being asked here is whether that would be considered to be a capital loss or an income loss. Is it trading or capital, Tim?
Well, it's a very difficult one, this one, and it's one that I could imagine you could end up going to the tribunal on, because on the one hand, it looks as though the taxpayer bought the property with the intention, as you said, of doing it up, refurbishing it, and selling it at a profit. Now, the revenue would indeed want to treat that, if it were eventually sold at a profit, as a trading profit. And I think it would be very difficult to argue against that being a trade of property development. The various badges of trade appear to be met. The difficulty here is that they didn't sell it at a profit, they sold it at a loss. And we've got what could be construed as a one-off transaction giving rise to a loss. And although the revenue would be keen to tax any profit, they will be far less keen to allow any loss. And the revenue would want to argue that this was not, in fact, a trade at all. But even if it was a trade, and I think there is some strong evidence that it was a trade, the revenue would then argue that the loss that arose in that trade was not allowable for sideways loss relief. The idea is that we should set that loss against the total income of the trader in the year of the loss. But the revenue would want to argue that it's not allowable because, and the amount of loss I think was 15,000, something like that. So they could have sufficient income to absorb that in the year of the loss. So we don't need to worry about the carry forward rules. But if it is a trade being carried on, then the revenue would argue that it was not being carried on a commercial basis with a view or reasonable expectation of profit. And that's the problem there. But it is a tricky one because, you know, if I was the revenue officer, I'd be in two minds about it. If I argue that it was a trade, but the loss is disallowed, the commissioner, not the commissioner, the tribunal might then determine that actually, yes, it was a trade, and yes, the loss is allowable. But then if the revenue argue that it's not a trade at all, then it would be a capital loss, and it could be the taxpayer has a loss to carry forward against it. So the jury's out. It is a tricky one. I suppose, having talked through it like that, I would tend to the view that the taxpayer was indeed trading, and that in this particular type of trade, there is the possibility of a loss, particularly if house prices, as they may well do over the next couple of years, move against you. And that doesn't mean that you were not trading on a commercial basis with a view to the realization of profit. So, you know, I would tend to go down that trading route and claim the loss, but it's very difficult to know whether or not a tribunal would agree. So we're going to sit on the fence on that one.
And of course, it's not specified in the question, but if this individual had perhaps done this a few times, if they had owned a number of properties where they'd done the same thing, this would be a very easy question in terms of trading. But without that extra evidence, if they have just done it once, it really is a very difficult one to answer. And so it seems slightly ridiculous, but we're in any answers answered. We're not going to answer the question. We're going to sit on the fence. Perhaps a perfectly good way to end the year. Hopefully you've enjoyed any answers answered this year. We look forward to seeing you next year, but keep well. And for this episode, bye-bye.